Good afternoon, and thank you so much for coming. As we do every year, we're Prestige Capital Worldwide, and as we do every year, we're running through a portfolio hold-sell analysis on the entire portfolio for Rhinebeck Capital. But specifically today, we're going to be looking at one project, and that is the Kingston office that we're currently invested in, and figuring out from management whether we want to hold or sell that. Before I do that, though, I'd love to introduce you to my team, my amazing team that makes up Prestige Worldwide, and we hail from around the globe. That's Robert Miller, Min Suk Ko, Hector Ayachiga de Leon, Naveed Ghatri, myself, Jacob Lorson, and Andre Cerruti. And once again, the agenda we're going to be running through today is on your left on the side, but we're really looking at a hold-sell analysis of the Kingston office, and management has given us 4 very specific scenarios to look at. And contingent on if we decide to sell that property, there is one scenario where management is also going to have us look at the Pipeline office building. And to walk you a little bit more about an overview for Rhinebeck and the firm, I'm going to pass it off to Naveed.
Thanks, Jake. So Rhinebeck Capital Partners is a real estate-focused investment firm that implements higher return strategies on behalf of its institutional investors. They're currently on their 4th fund, which is an $800 million closed-end commingled fund, which is 75% invested currently. What return metrics they're looking for are risk-adjusted IRR, levered IRR of 16 to 18%, and equity multiple of 1.6. So as Jake said, we are undergoing a portfolio-wide hold-sell analysis, and the property in question is going to be the Kingston office property. Management has come to us with 4 scenarios they wanted us to analyze and to recommend just one of them. The first one is going to be to sell this property and return the capital to investors. The second one is going to be to sell the property and reinvest those proceeds into a proposed pipeline development play. The third one is to hold the property as is and dispose of it down the line. And finally, the 4th option, which is the one we will be recommending today, is to hold the property, refinance it with one of 2 refinancing options that we were given. And to dive a little bit deeper about the market and the properties, I'm going to hand it off to Rob.
Great, thanks, Naveed. So first off, we'll go through the Kingston project, then we'll go through the pipeline. I'll give you guys some market overview. So this is Kingston, recently delivered 200,000 square foot Class A office. We really like this asset for a number of reasons, one of which is we're very far ahead in our business plan. We're currently 80% leased at about $50 full service gross. The market, since we've signed those leases, has risen steadily. So for the past 6 years or 4 years or so, it's risen by about 6% annually, which is very aggressive, and we love to see that. The other reason we like this asset is that the tenant base in the central business district is made up mostly of TAMI-type tenants, which are very conducive to the leasing strategy in our business plan at Kingston. So Kingston is as I said, 200,000 square foot, but it's got 25,000 square foot floor plates, which are very ideal for TAMI-type tenants. It also has a full feature set of amenities. So this asset works very well with our TAMI tenants. Now going ahead and moving on to the next one. So this is the pipeline opportunity. This is the complete spec project that we have lined up for us. And before I move forward, I just want to say that this is fully contingent right now. This is fully contingent on us exiting Kingston. So to move forward with the pipeline project, this is the 75,000 square foot fully entitled project in West Hamilton. It's been completely teed up for us by the developer, by the local sponsor. We like West Hamilton for a number of reasons, one of which is that it's highly supply constrained. So there is an arduous and very convoluted, difficult entitlement process that developers have to go through in West Hamilton. And as a result, there just hasn't been much supply. In fact, in the last 10 years, most of the developers bringing product online have been repurposing industrial spaces to either creative office or just regular Class B office. So this is a pretty unique opportunity for us. So not only is it supply constrained, but we've also got a number of Fortune 500 tenants, clients in the submarket, in the general market area, as well as existing and high credit tech tenants as well. We really like that profile. So it's good real estate. The other thing that I would like to point out here is that the sponsor who brought this to us, because it's fully teed up, it comes with some strings there. So the current JV partnership, as it's currently proposed, is pretty aggressive, and it shifts, in our mind, it shifts a good amount of risk to our LPs and our fund in general, and that's definitely something that we would want to push back on if we were to do this deal. Now, with that said, I will go ahead and move on to market analysis. So there's a lot of data up here. There are 3 things that I want to really point out to you guys. The first of which is the supply and demand discrepancy that we're starting to see in Class A office. So in terms of deliveries, I think we have about 26 million square feet planned to be delivered in this third quarter, whereas the demand for that office has fallen off about 30% since 2017. We're looking at about 18 to 19 million square feet of demand. So big discrepancy, especially if you start looking at it at an annual basis. You're looking at 25 million square feet or more of Class A office, which will come online. There won't be the demand that there was for that office space. So that's going to impact New York, or that'll impact markets that already have a good-sized development pipeline. That will impact those markets the most. Where you will see markets that are the most insulated, those markets will be those in which factors like entitlement keep supply very limited and supply very constrained. Those will be the most insulated from this trend. Now, secondly, moving on to interest rates. Obviously, we find ourselves in a rising interest rate environment today, and that impacts every single one of us in the room. And it impacts our cap rates. We're seeing property values being impacted by that. We're seeing our debt being impacted. Things are just becoming more expensive across the board as a result of these rising interest rates. And then lastly, last thing I want to leave you guys with here, the impact of tariffs on construction costs. So construction costs have actually already been rising. They were rising before the recent round of tariffs were announced. And actually since 2013, they're up about 25%. Obviously, the tariffs, they don't help that situation at all. But I think the key takeaway here is that you're looking at about 5 to 6% annual escalation in construction costs. And when we start looking at development deals such as pipeline, that becomes a big factor. How do you get around those? How do you get around factor? Well, that's when you start getting into things like a guaranteed max price contract, the GMAX, which is proposed on this deal, on the pipeline deal, but you need to make sure that it's executed at the right time in the joint venture and that you have the right clauses and covenants in there to make sure that you are protecting your downside as much as possible. Now, with that said, I will go ahead and pass it off to Andre, who's going to go ahead and walk you guys through the strategy and some options.
Thanks, Rob. So before we get into the weeds on the specifics of the different alternatives, I wanted to walk you through kind of the high-level strategy and thought process of how we approach this. So where we are today is we have the Kingston property. It's 80% leased, and we have the opportunity to sell it. And if we sell it today, we will earn an 18% IRR return and a 1.4 multiple. Now, those returns are already earned from the fund from the previous years. When analyzing the other deals, we wanted to make sure we focused exclusively on a go-forward basis. It is our fund's objectives to continue to deliver value to our investors, and so we need to make sure that by executing one of the different strategies, it will continue to deliver value to our investors over the next several years. So all the numbers that you will see today are exclusively from the value that we've already achieved today, moving forward over the next several years. So with that said, let's look at the first option. Sell Kingston today and deliver the money back to our LP base. Now, this is the safest option. If we are trying to bring back the risk profile of our fund, this is exactly what we should do. With that said, though, if we return the money to our LP base, we will no longer be having the money work moving forward over the next several years. And as fund managers, we will earn less in fees and promo, and our investor base will no longer be earning substantial returns on their money. So the only reason why we would really do this is if there was no good alternative to put the money to work in other situations, which we believe that there are. So we are going to ultimately recommend rejecting this option. The second option that management asked us to look at is to sell the Kingston property and use the proceeds from that to invest into the pipeline speculative office development. When we first looked at it, we really liked the pipeline deal. It's in a heavily supply-constrained market due to the entitlement process that Rob spoke about. This leads to high barriers to entry, which is great in any real estate deal. Over the past 10 years, there's been hardly any new Class A office brought on in this market, which will really allow us to have a unique product when coming online, as opposed to a commoditized product that we're just going to be competing on price with other developers. So we really liked that. In addition, we saw some opportunities to increase the returns on this deal. The sponsor is proposing only 50% LTC on the financing of this deal. We see that there's a little bit upside in that to lever up this deal. In addition, because we are bringing on a unique product for this market, we believe that there's potential for us to exceed our underwriting because there isn't really a great competitive set in the market for us to benchmark. So if we're able to truly deliver best in class and a unique product, we think there's potential for us to really exceed our underwriting on that. So this deal will require a $24 million investment from our fund, which will represent 80% of the equity capital stack. On that, we'll earn about 22% IRR return and a 1.5 multiple to our fund. Now, like I said, we saw some upside, so we wanted to see what that actually looked like. And as you can see, taking the leverage from 50% LTC up to 65% LTC really allows us to juice up our returns, about 600 basis points on the IRR, and about 15 basis points on the multiple. In addition, as you can see on the left column of the bottom chart, even just beating the NOI marginally really allows us to increase the returns on this deal substantially. So at this point, when we're looking at the deal, we really liked it. We thought this is a promising deal. But given where we are, potentially late in the cycle, with late cycle risk present, we really wanted to stress test this deal and really truly understand what our downside risk is. So when looking at it, we identified 4 major concerns and downside risks, and we really wanted to quantify what that downside risk looked like. So our sponsor relied on trended numbers to get to their underwriting. We think that this is a little risky, and it's important to understand what the untrended returns look like, because when you look on a trended basis, it relies on the market continuing to go in the way that it has, and being late in the cycle, it's potential that that might not happen. And as you can see, if we look at it on an untrended basis, the returns come down pretty substantially. In addition, the way that the JV is proposed right now, we will execute the JV agreement prior to a GMP being executed. This opens us up to substantial risk, especially given that tariffs could come in at any moment and drive the price of inputs up substantially overnight. And just an overnight change like that could really hurt the deal. And as you can see, increasing 12% really brings down our returns. Now, the last deal-specific risk that I wanted to walk you through is the hold period. So the sponsor is saying this is a 3-year deal from in to out. We think that that's pretty aggressive. As anyone in this room that's done construction knows, anything can happen. I mean, you can find anything in excavation, you can get sued, anything, and especially in this market, most major metropolitans are experiencing a serious shortage in the supply of contractors able to work on the projects, which is leading to a delay in the finish of them. And as you push out the hold period from 3.5 to 4 years, our returns really come down. So after looking at this, we started to realize that the risk profile of this deal was a lot greater than we initially expected it to be. And the 22% and 1.5 multiple returns, we didn't think justified the risk profile of the deal. And because of that, as proposed, we are recommending to reject this deal. So now I walked you through the different sell scenarios. I'm going to pass it off to Hector, who's going to walk you through the different hold and financing scenarios for the Kingston property.
Thank you, Andre. So on the hold scenarios, we basically analyzed 3 basic options. One is to extend the current term of the 50% LTV. The other one is to take a 65% LTV with new terms, and another debt structure with 75% LTV, also with new terms. We're proposing the 65% LTV, and I'm going to walk you through our reasoning on why we rejected the other 2. The 50% LTV, as you can see, does not meet the fund's objectives on IRR return metrics and equity multiple. Also, the 75% LTV, as it might look the best in return metrics, it exposes the project into lease-up risk and downturn risk also. So we finally chose the 65% LTV as it meets the fund's objective on 1, the return metrics, and 2, on the maximum allowed leverage for a project basis. That way we're minimizing our downturn risk, our lease-up risk, and we're maximizing nominal invested dollars and nominal profit dollars alongside with the returns.
we know that we've been through a lot, and we want to step back at this point, and for that, I'm going to pass the microphone to Jacob.
Thank you, Hector. As Hector said, I know we've been through several different options, but once again, I want to run over those high level, both qualitative and quantitatively, kind of what we just walked you through. The first were the two sell options. It was to sell Kingston now and return the money back to investors. Now, while this is the safest option, we think it leaves a lot of opportunity left and a lot of meat on the bone for that property because we really like the market. And we've already seen pre-lease 80%, and we think we can continue that strong growth to get up to 95% and capture that value. So we ultimately recommended rejecting that option. Secondly, we looked at selling Kingston now and investing in the pipeline deal. Well, we like this, and we really like the pipeline deal. Under the current terms from our JV, we just can't feasibly make it work, and we're worried somewhat about the downside risk. So we also rejected that option as of now. And lastly, we looked at what are the different ways we could hold and how would we finance that hold. And to do that, we recommend the 65% LTV because it allowed us to meet the fund level objectives on return while also minimizing risk and not going all the way up to 75% leverage on the LTV financing. So under the four scenarios management had us look at specifically, we choose to hold the Kingston property and refinance the loan at 65%. Now that being said, we wanted to see if there were alternative ways to really add value to the fund outside of these four scenarios. And to do that, I'll pass it off to Minsuk.
Thanks, Jake. Because we want to make more money, we overworked. And we came out with two more ideas. First idea is building residual value. As mentioned before, brokers offered us $109 million based on the exit cap, but we thought this is quite low, and it has upside potential. So we run our own residual value model, which is from the perspective of Core Plus Fund, which is target 8% IRR. And the result is $129 million, which is higher than $109 million. So we're going to recommend to shop this deal, the Kingston property, to Core Plus Fund. And if the offer price came in near the $129 million, then we're going to highly recommend to sell this property right now. And I'm going to pass it to Naveed for the second idea.
Thank you, Minsuk. So we wanted to see if there was a way for us to essentially be involved into both deals. And so what we figured out is if we can hold the Kingston property and refinance it, take those proceeds and put it into the pipeline development, it'd be possible. And we really like this idea because on one hand, using the proceeds from the refi, we don't have to make another capital call. And on the second hand, the return metrics look great. You know, we're capturing the upside on both properties. And as you can see up here, we're looking at returns of 27% IRR and 2.8 times equity multiple. Now, while this sounds nice, especially approaching the last 6 months of our investment period, which is set to expire Q2 of 2019, the only way we could see this really being feasible is modifying those JV sponsor terms that we've been proposed. And to dive deeper into that, I'm going to hand it off to Rob.
Great, thanks, Naveed. So you're absolutely right, and as I was talking about earlier, the JV terms are aggressive, and at this, as they're currently proposed, they're just a little too aggressive for us to get behind. On your left-hand side, I believe, is the current proposal as proposed by them. In the middle is our counter proposal to them, and then on the far right is what we would accept. I want to call your attention to just a couple of things here. So first of all, the construction debt term, 2 years plus 2 one-year options. The first option is tied to issuance of CO. The second one is tied to a leasing threshold of 50%. We just feel that given where we are in the cycle, how tight the labor market is, especially for construction labor, we wanted to give ourselves some more flexibility with that. So we would want to counter that and at least get 3 years plus a single one-year option, just to buy us a little bit more time in the case that something did come up. Now, lastly, I want to point out that we've got this construction GMP, which the JV is asking, or the sponsor is asking to have that executed after we invest. Obviously, that's unacceptable to us. We want to shift that risk. We want to have it executed at least upon closing with the JV, if not prior to that. That'll maximize our negotiating ability with that GMAX and allow us to negotiate it in such a way that we can be proud of representing the DLPs going forward. Now, if we are able to shift some of that risk, our returns improve substantially, and we feel we can get behind this deal. So with that said, I'm going to go ahead and pass it off to Jake, who's going to close us out.
Thank you, Rob. So just to finish, of the 4 scenarios management gave us, if we had to recommend one today, we would recommend on your bottom of your screen there, holding the Kingston property and refinance the loan at 65%. That being said, we would actually recommend to management to explore some of these alternative opportunities, because we think there's an opportunity to sell Kingston now at a higher value, and we also think there's another way to get into the pipeline property by changing up or modifying the structure. Thank you very much for your time, and we'll open up the floor now to questions.
Sure, yeah, I can address that. So, I mean, you speak about in construction, so we wanted to really stress test and see what could happen to the hard costs, because the GMP was not going to be executed prior to the JV being executed. And I know you say that we're not going to be excavating, but I mean, we're still going to probably pull out 5 feet and recompact at least, and then concrete costs and steel and et cetera, they can change overnight. So we wanted to ascertain what is kind of what we would see as the worst case scenario in a short period of time of construction costs changing. And that's kind of what we looked at, the 12% range. And so that's why we wanted to see the downside risk. That's not how we underwrote it, that's how we sensitized it and looked at the downside scenarios. And so we thought that by changing the deal terms, we're bringing down their promote and we're pulling some of the risk off of the table. So by increasing our return and bringing down the risk profile, we thought that we could get this deal into a situation where we thought that the returns that are coming towards our fund justify the risk profile of the deal. And so that's why we focused on changing the terms. And so in terms of what we would have to have in order to live with the deal, I mean, I don't think that we would ever touch a deal where we didn't get the GMP executed prior to the JV, that we would never live with that, period. Well, so the 12% wasn't in our base underwriting model. It was a sensitivity of the underwriting. It was fine, but given the risk profile of the deal, we would not be comfortable at that level. So but by increasing our returns and decreasing our risk, we thought we could get to a place where we would be comfortable with the deal. Any other questions?